Chapter 12, differential analysis and product. So differential analysis is management looking at different alternatives that they could take. So make or buy, or should we continue making this product or discontinue it? So here's 5 steps in the decision-making process. So the objectives of the decision, what do we want to decide? The alternative courses of action, so that'd be make or buy, or discontinue a product or continue making it. We gather our relevant information, so our projected revenues and costs and other impacts. Then we use all this information to make the decision. And then after we make the decision, we analyze the results of the decision we made. So differential analysis, we're looking at the effects of different alternatives. So make something or buy something. Continue a product or discontinue it. So we're using estimated revenues and costs. These things haven't happened yet, so we have to do some forecasting. We're looking at relevant revenues and costs based on those alternatives. We're not going to go out on tangents and put revenues and costs in that don't matter. And we have to ignore sunk costs that already happened in the past and that don't impact these alternatives one way or another. So if we paid cash for the factory 5 years ago, and both alternatives we're trying to decide on are going to happen in that factory, well, the cost of the factory is sunk. It already happened, so it's irrelevant. So some decisions that differential analysis is made. So leasing or selling equipment. Discontinuing an unprofitable segment. Should we discontinue that segment or continue doing it? Should we build our own part, or should we buy the part already made? Should we replace fixed assets, or should we fix them? Should we process a product further or sell the intermediate product? So, if a product goes through the manufacturing process and we have something, say we're manufacturing sheet metal. We can manufacture sheet metal, or we can manufacture it further and drill holes in that sheet metal. Should we sell the sheet metal, or should we sell the sheet metal with the holes drilled in it? That's what that means. And then accepting additional business at a special price. So should we give somebody a discount to do business with them? So the idea to lease or sell. So should we sell the equipment to somebody, or should we lease it to them? So we're looking at an example. The equipment originally cost $200,000 and accumulated depreciation is $120,000. So the two alternatives: we can lease the equipment for $160,000 less $35,000 in repairs and taxes, or we could sell the equipment for $100,000 and then we have to give somebody $6,000 in commission. So what's the better decision to make? Well, when leasing the equipment, we're making it's $160,000 minus $35,000, so we're making $125,000. Versus selling the equipment, we have to give the 6% commission away, so we're only going to make $94,000. So here's a differential analysis. So we're going to look at the revenue from both alternatives, the revenue from the lease and the revenue from the sale. So the differential revenue from the lease is $60,000, which means that the revenue is $60,000 higher to lease than to sell. Then we look at the cost alternatives. So the repair and insurance and property tax on a lease is $35,000, but we have to pay commission on the sale, 6%. So the differential cost of the lease is $29,000, which means the lease has $29,000 more in expense than if we sold it, 35 minus 6. So the net income from the lease alternative is $31,000, which means we're $31,000 better off leasing the equipment than we are selling it. So this is a differential analysis. And if we look at a traditional analysis where we just line them up against each other, it comes out to be the same thing. And remember, the $80,000 book value is a sunk cost because it already happened. So it's ignored in the differential equation. Differential analysis. And then our decision that we make based on our differential analysis, leasing the equipment would increase overall income by $31,000. So based on what we have here, leasing is the better way to go. Another decision we can make is to think maybe we could discontinue a segment of products. So we're looking at Montana wheat. We produce 3 kinds of cereal. Bran flakes is at an operating loss, so the company is considering to discontinue it. So if we look at the last column, income loss from operations, we go to bran flakes. It's showing an $11,000 loss. Well, should we discontinue bran flakes? That's our decision. So we're saying if fixed costs remain the same, is it the right decision to discontinue bran flakes? So if we look at our differential analysis in Exhibit 5, so we're going to lose $100,000 of revenue. And then we look at our cost, we're going to lose our cost of goods sold and the operating expenses, $85,000. So annual differential income from sales of bran flakes, so we're going to show we would increase overall profit by $15,000 by discontinuing bran flakes. Because but when we look at this a little bit closer though, discontinuing bran flakes would actually reduce the overall profit by $15,000. That's because the bran flakes are contributing to covering fixed costs. So what happens is our fixed costs remain the same. So we have one less product line to distribute those fixed costs towards. So our overall profit would actually decrease by $15,000. So if we look at our traditional analysis, we see that if we have all 3, our income from operations is $69,000. If we only have toasted oats and cornflakes, our overall profit is $54,000. So by discontinuing bran flakes isn't there to cover the fixed costs, and it actually decreased profit by $15,000. Common decision also is to make or buy. So if we need a part, we can either make it or we can buy it already made. So let's use an example. An automobile company, we've been buying a part for $240. We've been considering making the part at the following costs: direct materials, labor, overhead, variable, overhead fixed, and 80% capacity. Should we make or buy the part?